We stand at the edge of a financial wilderness, a landscape often painted with the vibrant, yet fleeting colors of speculation. Many are drawn to this realm by the siren song of quick riches, the intoxicating rush of a hot tip, or the feverish chase of market noise. It's a path paved with emotional highs and devastating lows, where gut feelings often masquerade as wisdom. This is the gambler's high, a state of being where hope and fear dance a chaotic tango, leading to decisions that are more akin to rolling dice than building empires. But there exists another path, a more deliberate journey. It is the path of the elite investor, an approach anchored in a foundational principle that has stood the test of time. Benjamin Graham, the venerable dean of value investing, taught us a profound truth in the intelligent investor *. We must treat stock ownership not merely as a fleeting ticker symbol, but as a genuine stake in a business. This is not about predicting the next market swing. It's about understanding the underlying value, the enduring substance of the enterprise itself. This fundamental shift in perspective introduces the singular skill that truly separates the calculated investor from the hopeful gambler. It's a skill that transforms speculative baits into deliberate, informed investments. It's the ability to look beyond the immediate clamor, beyond the emotional currents, and to find clarity within the data. This is the promise of a data-driven approach. It is the bedrock of sustainable wealth creation, an anchor in the turbulent seas of financial markets, guiding us not by chance, but by a compass of rigorous analysis. This skill, when honed, becomes our shield against the whims of speculation and our engine for enduring prosperity. The allure of a winning streak is a powerful force, isn't it? We see it in the gambler's eye, that hopeful glint that a lucky run will continue. In finance, this translates to the gambler's fallacy. It's the mistaken belief that because a certain outcome has occurred repeatedly, a different outcome is now due. We see a stock rise for a few days and instinctively feel it must fall, or vice versa. This blinds us to the underlying probabilities, to the statistical realities that govern market movements over time. It's a seductive illusion that leads many astray, mistaking fleeting momentum for enduring strength. Consider the poker table. A skilled player doesn't just play their cards, they understand the odds. They know the probability of drawing an ace or completing a flush. They base their baits not on a sudden surge of confidence, but on a calculated assessment of what the data, the cards on the table, the betting patterns, suggests is most likely to occur. Conversely, a gambler at the poker table might rely on reading tells, on a gut feeling about their opponent. This is precisely the difference we see in investing. The market whisperer, with their charismatic pronouncements and unwavering confidence, often masks a profound lack of data-driven conviction. Their pronouncements, however compelling, can lead to catastrophic, gambler-like decisions because they are not rooted in the cold, hard facts. This is where our one skill truly shines. It's about embracing the probability prism, about deconstructing the illusion of luck and understanding the underlying probabilities. We must implement a probability log. This isn't about predicting the future with certainty, but about systematically tracking our investment thesis. What data supported our decision? What outcome did we expect? And crucially, how did reality unfold? By reviewing these logs against actual market performance, we begin to see the patterns, to understand where our analysis was sound and where it fell short. This rigorous self-examination is how we begin to weigh the ephemeral vote of market sentiment against the enduring weight of intrinsic value, a concept Benjamin Graham so eloquently described when he said, "The stock market is a voting machine in the short run, but a weighing machine in the long run. The mind, a magnificent instrument, can also be our greatest adversary in the realm of investing." Gamblers are often ensnared by cognitive anchors, those ingrained reference points that color our perception. Imagine being anchored to the purchase price of a stock, even when the underlying business fundamentals deteriorate. The emotional attachment to what you paid can cloud your judgment, making it difficult to admit a mistake. Then there's confirmation bias, the insidious tendency to seek out and interpret information that supports our pre-existing beliefs, while conveniently ignoring anything that contradicts them. These biases create formidable blind spots, turning objective analysis into a subjective echo chamber. We saw this play out with devastating clarity during the housing market bubble of 2008. So many investors were anchored to the seemingly endless rise in property values. They sought out data that confirmed their belief that prices would continue to climb, dismissing the mounting evidence of overvaluation and unsustainable lending practices. This fervent confirmation of existing beliefs, coupled with the anchor of past performance, blinded them to the impending crash. The elite investor, however, possesses a crucial discipline. They understand that their initial thesis is not sacred scripture. They actively seek out disconfirming evidence. When new, objective data emerges that challenges their pre-existing beliefs, they don't shy away. They embrace it. This willingness to reevaluate, to pivot based on truth rather than attachment, is a hallmark of their success. To cultivate this discipline, consider a powerful mental exercise, the pre-mortem post-mortem analysis. Before you even commit capital, imagine that your investment has failed spectacularly. What were the most likely reasons for this catastrophic outcome? By forcing yourself to confront potential negative scenarios and the data that might signal them, you confront your own biases head-on. Elite investors use data as a compass, constantly recalibrating their course based on true north, the fundamental reality of the business. Gamblers, on the other hand, are often swept away by the wind, chasing the fleeting noise of market sentiment. The gambler views risk as a thrilling gamble, a necessary evil for the chance of outsized gains. They speculate with capital they cannot afford to lose, driven by the sheer excitement of potential windfalls, often with little regard for the downside. This is not risk management, it is a reckless dance with financial ruin. The elite investor, however, understands that protecting capital is paramount. Their approach is defined by a profound respect for risk, embodied by Benjamin Graham's timeless principle, the margin of safety. This isn't about timidly avoiding risk, it's about intelligently mitigating it. It means buying assets at a significant discount to their intrinsic value. This buffer, this margin of safety, acts as a vital shield against unforeseen market events, unforeseen economic shifts, and, crucially, our own analytical errors. It's the difference between building a sturdy bridge and a flimsy one that might collapse under the slightest strain. Here lies a hidden truth. The true cost of poorly managed risk isn't merely the potential capital loss, it's the devastating opportunity cost. When a single, ill-conceived bet wipes out a significant portion of your portfolio, you're not just out of pocket, you're often forced to the sidelines, unable to participate in future market recoveries or capitalize on genuine opportunities. This is the gambler's ultimate penalty. The elite investor, therefore, employs a deliberate strategy of position sizing. This involves assessing both conviction in an investment thesis and the inherent risk associated with it. The goal is simple yet profound. Ensure that no single losing trade, however painful, can cripple the entire portfolio. Think of it like sailing. A skilled sailor meticulously consults weather forecasts, understands their vessel's capabilities, and designs their journey to withstand storms. They are prepared. A gambler, on the other hand, might simply set sail into a hurricane, hoping for the best, relying on sheer luck rather than informed preparation. That, in essence, is the fundamental difference. The gambler's mind operates in absolutes. Their questions are stark, binary. Will this stock go up or will it go down? It's a black and white world, a simplistic view divorced from the nuanced reality of financial markets. This yearning for certainty, for a definitive yes or no, is a breeding ground for speculation and disappointment. They crave a crystal ball, a guarantee, when the market offers only probabilities. The data-driven investor, however, navigates this world with a different lens. They understand that certainty is an illusion. Their focus shifts from predicting a single outcome to understanding the likelihood of various scenarios. This is the essence of the one skill in action. It involves rigorously analyzing fundamentals, understanding macroeconomic currents, and poring over historical data to construct a distribution of probable outcomes. It's about embracing the spectrum, not just the poles. Consider a company's future earnings potential. The gambler might bet on a single, wildly optimistic projection. The elite investor, armed with data, views this potential not as a fixed point, but as a range of likely outcomes. Each outcome, from the most optimistic to the most pessimistic, is assigned a calculated probability based on thorough research. This is where simple statistical tools become invaluable. Calculating the standard deviation of historical returns, or analyzing a company's price-to-earnings ratio within the context of its industry averages, helps to quantify uncertainty and ground expectations in quantifiable reality. Elite investors, in this regard, are akin to meticulous actuaries. They spend their time calculating odds, assessing risk, and building a robust understanding of what is likely to occur based on evidence. Gamblers, on the other hand, often resemble fortune tellers, relying on unseen forces, gut feelings, and wishful thinking. The data, when approached with the right skill, reveals the true probabilities, transforming speculative hope into informed strategy. The gambler's focus is relentlessly short-term. They chase quick wins, the immediate gratification of a rapid profit, driven by an impatience that propels them into constant trading. Each transaction, each quick buy and sell, incurs fees and taxes, silently eroding the very power of compounding. This frantic activity, while seemingly productive, is often a sophisticated form of self-sabotage, a distraction from the true engine of wealth creation. Contrast this with Warren Buffett's profound insight: "Our favorite holding period is forever." This statement is far more than a platitude about patience. It speaks to the core of the one skill. It implies making high-conviction, data-backed decisions so sound, so fundamentally strong, that they justify holding an investment for the very long term. It's about identifying not just a stock, but a business of enduring quality. This is where the one skill truly manifests. It's about identifying businesses possessing sustainable competitive advantages, what Warren Buffett famously famously calls economic moats. These are the structural advantages that protect a company from competition and allow it to generate predictable cash flows. These moats are the fertile ground where long-term compounding thrives. To put this into practice, we must build an investment thesis that is crystal clear, a narrative built on data, not dreams. This thesis must articulate precisely why a company is a compelling long-term prospect. It details the strength of its moat, the quality of its management, and a valuation that offers a margin of safety. Once this thesis is established, the discipline is to stick with it, to remain steadfast unless the fundamental underpinnings of the business change. It's the difference between a gambler playing a slot machine, a game of pure chance with ephemeral rewards, and an elite investor planting an oak tree. The tree grows slowly, deliberately, its strength built over years, eventually yielding abundant, enduring returns. We've journeyed through the heart of what truly separates the elite investor from the gambler. It's not luck, nor is it a mystical intuition. The singular, pivotal skill we've uncovered is an unwavering commitment to data-driven analysis, a deep understanding of probability, and the disciplined practice of robust risk management. This is the bedrock upon which sustainable wealth is built, the quiet engine that drives long-term success. The transformation is profound. It's the shift away from the emotional, unpredictable roller coaster of gambling, where fortunes can vanish as quickly as they appear, to the steady, deliberate ascent of strategic wealth building. It's about replacing the thrill of the gamble with the quiet confidence of informed decision-making. Think of Warren Buffett, who treats investing not as a casino game, but as a partnership in sound businesses. This philosophy is not born of chance. It is the direct result of this rigorous, data-driven discipline. Your statistical compass is now within reach. This isn't about memorizing charts or complex formulas, but about embracing a process. Commit to this rigorous path. Challenge your assumptions relentlessly. Question the noise. Let the objective, verifiable data be your guide, your unwavering compass in the often turbulent seas of the financial markets. This skill is not merely a tool for accumulating wealth. It is the key to unlocking true financial independence. It empowers you to make rational, informed decisions, free from the emotional shackles that bind so many. This is the path to mastery, to a future where your financial destiny is shaped by knowledge and strategy, not by the fickle hand of chance.